about every 80 years, we have a financial revolution. The entire financial markets reset. And that's what we're witnessing. We're witnessing the end of a sovereign debt bubble. So all the big nations of the world have taken on too much debt. They're in a massive bubble, and they're all crashing right now. And that's what we're witnessing right now. And we can see, of course, the biggest central bank in the world, the U.S. Federal Reserve, and the head of that, Jerome Powell, has been busy trying to talk down markets. And all eyes have been on the Fed because the Feds have been hell-bent on bringing the markets down. When I say the markets, I'm talking about the asset prices. I'm talking about the asset prices. So you have to understand there's a big difference between the economy and the asset prices. So you saw in 2020, all the businesses were shut down. The whole world was shut down, but yet asset prices went to new all-time highs. So we don't have to look at the asset prices and the economy together. And the Fed has been hell-bent on bringing asset prices down because they want you to feel broke. Because if you feel broke, you don't buy as many things. And if you don't buy as many things, their hope is that then prices or inflation comes back down. So the Fed's been hell-bent on raising rates at the fastest rate in history to try to slow things down. And they've done a good job of bringing the markets down. The markets have come crashing down. The problem is that now we're at this point where the markets, the traders, the investors, don't really believe the Fed anymore. They don't believe the Fed is capable of doing what they're going to do. And I say capable because I think, at least for me, and I would think for most people, we believe that the Fed and Jerome Powell means what he says. We believe that he's serious. We believe that he believes it. So when he says that he's going to raise rates and keep them there for a long time, I think he believes it, and he means that. But he also said that they were going to lower rates and they wouldn't raise them for 4 years, and then they did after 2. Now, when he said they wouldn't raise them for 4 years, I think he believed and meant that as well. But what happens is things change. Conditions change. There's constraints, and they couldn't face this massive deflationary crash. They couldn't face that, so they had to they couldn't deal with this massive inflation, and so they were forced to raise rates. Inflation came on way faster, way harder, and way more sticky than they thought it was going to be. Remember, they kept saying it's transitory, which it wasn't. And so when it was found to be sticky and it wouldn't go away, they were forced to raise rates sooner than the 4 years they had predicted. And so now Jerome Powell's committed to it. He's committed to continuing to crush the markets, and he's committed to taking rates high and leaving them for a long time. The problem is, even though we believe him, we understand that there's constraints that will keep him from doing that. And so that's kind of where we're at, and we're already starting to see the signs of this being angled. There's a couple signs to look at. I think one sign is that the government, the U.S. government and the Treasury is at odds with the Federal Reserve. And so those two have different interests. The Federal Reserve wants to protect the monetary system. That's the dollar and the banking system. While the government wants to, of course, not go out of business, not go broke and not default on their debt. The U.S. government wants to continue to buy votes through social spending and not go bankrupt. They don't care about the dollar, really, and they don't care about the monetary system. That's not their viewpoint. And so we have the Treasury being headed by Janet Yellen, and we have the Fed headed up by Jerome Powell, and they have different viewpoints. They have different goals and objectives. And so we're at this interesting inflection point, and we've seen the government is starting to angle to force the Fed's hand. A couple things that happened. One, we saw the BLS, the Bureau of Labor Statistics, went and changed the calculation on CPI, which is the way that we measure inflation. So if the Fed is focused on bringing inflation down, and they're going to commit to it until the inflation is back down, well, the BLS, the government, just went and changed the calculation, which just brings inflation down. Easy. We don't actually have to bring inflation down. Let's just change the way we calculate it. And that's exactly what they did. And that starts to push the Fed's hand. On top of that, Janet Yellen has been pivoting the Treasury to play with the Treasury market without the Fed involvement. Now, this kind of leaves them stuck, and now we're starting to see the Fed starting to come around to this. And so what we saw is that the Fed meeting just happened for January, and they decided to raise interest rates only 25 basis points when they had originally been expecting a 50-point basis hike. So what does that mean? That means they're not pivoting, but they're slowing to a pause. So as they're raising rates, a pivot would, to me, mean that they're now lowering rates. A pause means we're just going to hold and we're going to stay where we're at. And so they decided to raise rates only 25 basis points, and they said that there would be, quote, ongoing increases, potentially, but because inflation has eased somewhat, they reserve the right to do more, but we'll see how it goes, sort of thing. And so this is like a softening. The Fed really wants to get this 2% inflation target, but they're already well on their way. And I think with a combination of the direction that we're already headed, which is heading down to 2%, in addition to the way that it's been recalculated now, I think it very clearly shows you that they're about to obtain their goal, and we can have that pivot. If we look at some of the things that the Fed said, a couple things, they talk about this thing called the terminal rate. And the terminal rate is how high do we need to raise the rates in order to get the markets or inflation to come down on its own. The problem is because inflation isn't like a light switch that can just be turned on and off, it takes a long time for that inflation to come down. So how do they know that they haven't already achieved the terminal rate? What if they've already achieved the terminal rate, meaning the rate's high enough now to bring CPI inflation down? What if they've already achieved that rate, but they keep hiking anyway? Well, that could be bad. As a matter of fact, that's my base case. Most likely they will continue to go too far, just like they always go too far. Just like they lowered rates too low and they kept them too low for too long. Now they've probably raised them too high and they'll probably keep them too high for too long. And they just go from breaking one thing to breaking the other back and forth. And this is causing a lot of problems in the markets. It's also causing a lot of problems in the economy. And that's really where we want to look for things. A lot of people looking at the stock markets, but the stock markets are what we call lagging indicators. They tell us what's already happened. What we want to look at is like the leading indicators. So we want to look at the debt markets. Then we want to look at like the producers index, how much the manufacturers are paying to produce things. And then eventually we can look at the CPI and then we can look at the stock market, right? But let's say, for example, we're looking at the unemployment data, right? Unemployment's also another lagging indicator because as an employer, the last thing I'm going to want to do is let go of my employees. So my business is going to be bad for a long time. I can't get new debt. I can't expand. I can't roll my debt over. My customer base is shrinking. I don't have enough money. I'm running out of money. Maybe I haven't paid my electricity bill this month. I keep hoping things are going to get better and they don't. And then finally I have to lay somebody off. But things have already been bad for a long time for me. And then I lay somebody off. Now that person might get 30 days, 60 days, 90 days of severance. So they don't even show up on the unemployment numbers for months after the business already started having a problem. And so when we start looking at some of this economy data, it looks pretty bad. And it's one of the other reasons why I think the Fed is going to continue to come off of this, ease off of this, and go into this pause reaction.